if things continue to worsen from here, then this risk is going to spread not just from these two names, but it's going to be throughout the technology space.
Hey everyone, thanks for joining us. This is Chad Smith and Stephen Weitzel from Reveille Wealth Management. And we're just hopping on here today to give a quick update on some developments this week that relate to the AI infrastructure boom. And as we have been highlighting of late, some concerns that we have had, and the market is, of course, also beginning to grow concerned about the sustainability of this boom that we're in. And in looking for any signs that there's some vulnerability of that narrative in the market that has sustained the market for so long now. So, Stephen, why don't you catch us up on what we've seen develop here this week? Very quickly, I'll point out Stephen's on the road in Florida visiting clients this week right before Christmas, so he's able to hop on remotely and let's have a brief chat about this.
Yeah, thanks, Chad. So again, this is really just a continuation of the saga that we've been highlighting for a number of months now. And we talked about how companies like Oracle and Blue Owl, which were very close to the epicenter of this whole AI boom build out, is it actually feasible, sustainable? Are we going to see it come to fruition the way that the market has really hyped it up to be? We've talked about the ways that the market has grown quite skeptical of that. And as we were over the last few weeks preparing for our upcoming podcast, where we're going to dive into, are we in the biggest bubble that we've seen in our lifetimes? I previewed, if we are in one of those environments, then what could be the catalyst for that to happen? And it would probably be that one of these big players in the AI build out starts to renege on some of their commitments. And so we highlighted Oracle, we highlighted Blue Owl. Well, last week, we're sitting in a meeting in our conference room, and there's a headline that comes across where Oracle is going to delay one of their data center build outs from 2027 to 2028. Seems like maybe it's not that big of a deal, but that's always your first foray into it. And then this week, we get the story that Oracle's got another data center that they're building in Michigan, a very big one, $10 billion facility that Blue Owl was potentially going to be helping to fund, as they've done so many of them. And Blue Owl says, we're out. We're not doing this one. And it sent shockwaves across the market as that story hit the news wires. And it's really just corroborating the concern that the markets have had for the last couple of months, that things have gotten too extended. And now some of these companies are saying, no, Moss, we're not doing it right now. And that's always the first sign of what we think that we might see if we are in a real slowdown.
Yeah, absolutely. And so I've brought up here on the screen the credit default swaps, the chart of the credit default swaps of Oracle. And we mentioned these before in a previous couple of videos, actually, where we were highlighting the growing concern in the market, especially among bondholders of bonds issued by Oracle, about the risks that are developing within their balance sheet, presumably, but also the sustainability of what they're doing. So just for context, so Oracle, again, is announcing all these large deals along with many other large cap tech companies of investments into AI infrastructure. Several companies, including even Microsoft, have gone out and borrowed. They're not just using cash on hand, but they're borrowing, increasing the debt level on their balance sheet to do a lot of this, the mega investments that have been talked about. And so, lo and behold, Oracle makes this announcement, and we highlighted this before back in September of a mega investment and a deal with OpenAI. Stock pops dramatically out of excitement, but then now, ever since, it's drifted down, and ever since that moment, the credit default swaps, which are a way for bond holders to insure against or hedge against the risk that Oracle could default on their debt. When there's risk, perceived growing risk in the market, just like in the insurance market, property and casualty insurance, risks elevate for around some event, the cost to insure goes up. So we see that in the credit default swaps, the cost to insure against loss and Oracle bonds is rising dramatically, and that is a reflection of growing concerns about the risks of the massive investments. And so, lo and behold, as this risk is growing, and yet now we see, like you mentioned, in the last 2 weeks, two announcements of delay or deferment or some other form of a snag in the plans of these massive investments or massive data center investments and infrastructure and AI in general. So it's like a lot of the concerns you see in the growing concerns you see in the market are already starting to come to fruition a little bit.
Yeah, and I would say that I think it's probably much more likely that it's not so much that the companies themselves are having to pivot their strategy, it's that the market is shutting them out. The bond market is telling the oracles of the world, we're not doing this anymore, right? The
Right.
cost of insuring their bonds, right? Their CDS is up by a factor of 3 in the last 90 days. Their
Yep.
stock price in that same period of time, I know you got it pulled up here, is down almost 50% in that same period of time. So
Yep.
things are not necessarily unfolding the way that they had hoped. Maybe I'd say broadly the way that the market would have hoped. And this is just one example of the risks in the market right now, right? Between
Absolutely.
Oracle, right? We can pull up a chart of Blue Owl and we'll see something very similar that it's trading well off its highs. It's down nearly 50%. It was down nearly 50% from its highs. Tried to recover and bounce up, but found some resistance and has really rolled over and started to move back down again. And so these are things that we're just going to continue to keep our eye on. We can, provide this update, the latest in this saga for these two names that are so close to this area of the market. And
Yep.
they don't seem to be healing.
Right.
Certainly the way that the tech bulls would need it to happen. And so uh,
Yep.
people, they need to tune in for our upcoming podcast where we're going to be talking about, are we in this big bubble and what they need to do to be able to protect themselves. Because if things continue to worsen from here, then this risk is going to spread not just from these two names, but it's going to be throughout the technology space.
Right.
Yeah, I know you and I talked
And
about it earlier today, but some of these leading semiconductor companies like Broadcom and Nvidia, they've traded down 20% off of their highs recently, right? So Broadcom, they're down over 20% in the last week. The calculus in the market is changing quickly, and so these risks are elevated in the market. They don't seem to be going away. And the story that we got about this data center in Michigan, where Blue Owl is saying we're stepping back, is just another example to corroborate that there is a slowdown in the market. Risks are going to veto the build out that a lot of the AI bulls want to see.
yeah, absolutely. And so what we're trying to highlight, and again, this is just another moment where we've been, kind of bringing to light these developments in the market, but we're trying to highlight the fact that while the AI build out, the AI boom, arguably the fourth industrial revolution, or whatever sequence we are now, but it is absolutely society changing. It is having an incredible impact. Great benefits are ensuing from it, concerns as well, of course. But what we've been highlighting in other material is that those that are making the massive investments in the infrastructure are not necessarily the ones that are going to reap all the benefit going forward. And the market's already priced in such expectations around these companies that now much has been kind of baked into the cake, so to speak, in the market. And there are things that can develop that can upset that. And with such high expectations, lofty valuations, et cetera, and at work, you're starting to see these names give way, but yet that not only is a risk to the market and a risk to these names, but it also is at the same time an opportunity for us to look at areas of the market that could benefit from the employment and the just in general utilization of AI to do things better, be more productive, cut costs, et cetera. And that's what we're looking at is rotation in the market where that's beginning to start to take hold. And so in these leading AI infrastructure names, you're now seeing these downtrends at place, like CoreWeave I have up here, another highly anticipated IPO this year. It went up dramatically, a lot of hype and expectation, and then now it's come way down from its high. So we want to just highlight these changing cycles in the market, the risks that are there, and how we can work diligently to identify them and avoid them and navigate around them in the landscape.
Thanks everybody for tuning in. We'll continue to apprise you when we get more updates around these names, because again, we think that they're the ones that give us the best glimpse into how this AI slowdown may be unfolding. But make sure that you're subscribed to our channel so you're getting these updates as they're available, and also be on the lookout for our newest podcast, Are We in the Biggest Bubble of Our Lifetimes? We're going to be continuing to address these concerns in that discussion. So hope everybody has a great holiday, and we'll look forward to catching up with you soon.